ACCA, Corporate Fraudulent and Criminal Behavior. Introduction. Welcome to Corporate and Business Law, focusing on corporate fraudulent and criminal behavior. In this final video, we will explore what constitutes corporate fraud and criminal behavior, key legislation governing corporate misconduct, enforcement bodies and their roles, penalties and consequences for corporate crimes, directors' responsibilities in fraud prevention. What is corporate fraud? Corporate fraud involves deliberate deception to gain unfair or unlawful advantage. Key characteristics: intentional misrepresentation of facts, designed to deceive stakeholders, results in financial or other advantage. Common forms include misrepresentation of financial information, theft or embezzlement of company funds, bribery and corruption schemes, insider trading using confidential information, false accounting and record manipulation. Common types of corporate fraud. Corporate fraud manifests in various forms. False accounting, deliberate misstatement of financial records, manipulation of revenue, expenses, or assets. Asset misappropriation, theft of company money or property, unauthorized use of company resources. Payroll fraud, ghost employees or inflated wages, fictitious expense claims, bribery and corruption, payments to influence business decisions, conflicts of interest, tax fraud, deliberate evasion of tax obligations, false claims and declarations, money laundering, concealing illegal origins of money. False accounting example. Let's examine a practical example of false accounting. Scenario: revenue inflation. Company's actual sales equals £1,500,000. Company reports sales equals £2 million. False reporting equals £2 million to £1,500,000 equals £500,000. Consequences: misleads shareholders and investors about company performance, may affect share price and investment decisions, violates duties to provide accurate financial information, potential criminal and civil liability for those involved. Criminal corporate behavior. Corporate crimes extend beyond fraud to include financial crimes, fraudulent trading with intent to defraud, market manipulation and insider dealing, regulatory violations, environmental law breaches, health and safety violations, competition law infringements, corruption offenses, bribery of officials or business partners, facilitation payments. These crimes can be committed by individuals within companies or by companies as entities. Fraudulent versus wrongful trading. Understanding the distinction between these related concepts. Wrongful trading. Continued trading while knowing insolvency is likely. Civil liability for directors. No requirement to prove intent to defraud. Fraudulent trading. Carrying on business with intent to defraud creditors. Both civil and criminal liability. Requires proof of deliberate intent to deceive. The key difference is the element of intent to defraud. Fraud Act 2006. The UK Fraud Act 2006 defines three main types of fraud. False representation. Making representations known to be untrue or misleading. Includes statements about facts, law, or state of mind. Failure to disclose information. Failing to disclose information when legally obliged to do so. Breach of fiduciary duty to disclose. Abuse of position. Occupying position of trust and abusing that position. Expectation of financial gain or causing loss. Maximum penalty, up to 10 years imprisonment and unlimited fines. Bribery Act 2010. The UK Bribery Act 2010 creates four main offences. Active bribery. Offering, promising, or giving bribes. Passive bribery. Requesting, agreeing to receive, or accepting bribes. Bribery of foreign officials. Bribing foreign public officials to obtain business. Corporate offense. Failure of commercial organizations to prevent bribery. Maximum penalties, unlimited fines and up to 10 years imprisonment for individuals. Corporate criminal liability. Companies can be held criminally liable under certain conditions. Requirements for corporate liability. Senior individuals with authority acted illegally. Actions were within scope of their employment or authority. The individual's mind and will represents the company. Senior individuals typically include directors and senior managers. Those with decision-making authority. Individuals controlling company operations. Companies face unlimited fines and potential business consequences. Money laundering. Money laundering involves concealing the illegal origins of money through three stages. Placement. Introducing illegal funds into legitimate financial system. Often involves cash deposits or purchases. Layering. Creating complex transactions to hide money trail. Multiple transfers between accounts and jurisdictions. Integration. Re-entry of funds into economy as apparently legitimate income. Investment in legitimate businesses or assets. Each stage makes detection increasingly difficult. Proceeds of Crime Act 2002. This UK legislation creates several money laundering offences. Principal offences. Acquiring, using, or possessing criminal property. Facilitating acquisition, retention, use, or control of criminal property. Failure to report. Regulated sector must report suspicious transactions. Failure to report is criminal offense. Tipping off. Warning someone they are under investigation. Prejudicing money laundering investigations. Maximum penalty, up to 14 years imprisonment. Insider dealing. Insider dealing involves trading securities using confidential, price-sensitive information. Criminal Justice Act 1993 covers dealing in securities while possessing inside information. Encouraging others to deal based on inside information. Disclosing inside information to unauthorized persons. Applies to directors and employees. Professional advisors. Anyone with access to inside information. Maximum penalty, unlimited fine and up to 7 years imprisonment. Whistleblower protections. The Public Interest Disclosure Act 1998 protects employees reporting wrongdoing. Protected disclosures include reporting criminal offenses, breach of legal obligations, miscarriages of justice, health and safety dangers, environmental damage, deliberate concealment of any of the above. Protection includes protection from dismissal, protection from detriment, right to compensation if victimized, regulatory and enforcement bodies. Various agencies investigate and prosecute corporate crimes. Serious Fraud Office, SFO. Investigates serious or complex fraud cases. Prosecutes major corporate fraud. Financial Conduct Authority, FCA. Regulates financial markets and services. Investigates market abuse and misconduct. HM Revenue and Customs, HMRC. Deals with tax fraud and evasion. Criminal investigation powers. National Crime Agency, NCA. Tackles serious organized crime including corporate crimes. Directors' duties in preventing fraud. Directors have responsibilities to prevent fraud within their organizations. Establishing controls. Implement robust internal control systems. Regular monitoring and review procedures. Clear policies and procedures. Ensuring transparency. Accurate financial reporting. Proper disclosure of material information. Regular board oversight. Training and awareness. Employee training on anti-fraud policies. Regular updates on legal requirements. Clear reporting mechanisms for concerns. Prompt action. Investigate suspected irregularities. Report criminal activity to authorities. Take disciplinary action where appropriate. Penalties and consequences. Corporate crimes carry severe consequences. For individuals, criminal fines and imprisonment. Disqualification from acting as company director. Civil liability for losses caused. Professional sanctions and license revocation. For companies, unlimited criminal fines. Regulatory sanctions and license revocation. Civil claims from affected parties. Serious reputational damage. Loss of investor and customer confidence. Additional consequences. Exclusion from public contracts. Difficulty obtaining credit and insurance. Increased regulatory scrutiny. Mathematical example: misreporting profits. Let's examine the financial impact of false accounting. Scenario: actual company profit equals £100,000. Reported profit equals £150,000. False reporting equals £150,000 to £100,000 equals £50,000. Tax implications at 20% rate. Tax on actual profit equals 20% times £100,000 equals £20,000. Tax calculated on false figure equals 20% times £150,000 equals £30,000. Potential tax overclaim equals £30,000 to £20,000 equals £10,000. This misreporting could trigger investigation for both false accounting and tax fraud. Conclusion: we have comprehensively covered corporate fraudulent and criminal behavior. Corporate fraud involves intentional dishonesty for unlawful advantage. Various laws, including the Fraud Act 2006 and Bribery Act 2010, govern corporate misconduct. Both companies and individuals face serious criminal and civil consequences. Multiple enforcement agencies investigate and prosecute corporate crimes. Directors have crucial responsibilities for implementing effective fraud prevention systems. Strong internal controls and ethical cultures help minimize fraud risks. Understanding these principles is essential for directors, managers, and professional advisors to ensure legal compliance and protect stakeholder interests. Thank you for watching. We have covered the essential elements of legal systems, obligations, employment law, business formation, corporate finance, company management, insolvency, and corporate crime. This knowledge provides a solid foundation for understanding the legal framework governing business operations and corporate behavior.